to me a little bit about copper. If I heard you right, I think you said net shorts,
right.
Record shorts here on copper. So do you assume further downside along with slowing global growth, or is that simplifying it too much?
Well, I think, again, let's ask how much of a growth slowdown has the market priced in? I think it's priced in far much of a larger slowdown than what you're seeing in the economic data. In fact, I would say what we're seeing right now is an export recession. Those are big exporters are the ones that are being hit everywhere in the world. Importers, on the other hand, are drawing down their inventories. They're destocking, which brings us to copper. So as you begin to destock a lot of these end-use types of goods because you're waiting for a trade war to be resolved, you're going to have to go back and replenish these inventories, which should give you a pop. Fundamentally, we like copper. You know, our target is $7,000 a ton. We're trading $5,700, $5,800 right now because the fundamental picture, whether you're talking about supply, supplies have tightened up significantly, but the demand picture, again, it's middling. Not great, not bad. In China, you still have the property market. You still have the infrastructure and grid markets. Yes, manufacturing bad, which is an exporter, so exporter-driven weakness. The rest of the picture, I would say, doesn't warrant this type of pullback.
Maybe the most important discussion over the last 48 hours was a recession. Are we headed to one or not?
Yeah, I always like to tell people to explain to me how we get to one.
Well, that was going to be my question.
Yeah.
Normally people say it's got to be a policy mistake, right? And I've actually asked Mohammed Al-Arian yesterday, was the 25 basis points last December, was that enough of a mistake? But is it possible, you've got a PhD in economics from Chicago, you know the answer to this question, is it possible to get there just through sentiment? Could we talk ourselves into a recession?
When you look at the markets, let's take like shale and so forth, like they begin to respond. You saw actually, is the 25 basis point cut a response to sentiment in markets, or is it a response to real hard data? There's a question there. But in terms of thinking about the systems adjust to this. That's why when you look at it, you just don't keep going one direction, you'll come back around. And I think that the key there is you look at the market, central bank and policy have adjusted around the world. Even like Saudi Arabia, they took an insurance policy out in terms of cutting production right now to try to rebalance these markets. So I look around out there, you've got a lot of bullish factors out there that say go out and buy these markets. And I stand by our bullish view right now and am relatively positive.
So then square the two for me between copper and gold. Copper, we know you're bullish on, looking at 7,000. Gold, though, it surpassed your target of 1475.
We just took it up. Okay. We're at 1,600.
Okay.
And I think there's beyond just the sentiment issues and concerns about recession. What you also have taking place is the de-dollarization story. Central banks in emerging markets are buying gold. Russia bought 200 plus tons of it last year. Poland just bought 100. China's buying 10 tons a month at this rate right now. Why? Because they don't want to own dollars with sanction risk, geopolitical risk, trade war risk out there. Second factor is the ETF demand. Institutional investors in Europe as well as the U.S. are going to have more demand for gold going forward, again, given the type of geopolitical risk. We put it together, and that's what gets us to our $1,600 target.
So you raise a really important issue, whether the United States could use the sanctions of the dollar so much that it really diminishes, doesn't eliminate, but diminishes the role as a reserve currency. Is that a real threat? Do you see it that much?
It's already beginning to happen in places like Russia. They sold somewhere around, $83 billion of U.S. treasuries. From what I've heard, they replaced 40 billion of it in gold, 40 billion actually in greenbacks that don't use a SWIFT system. In terms of being, because essentially it was anti-money laundering laws and the SWIFT system that give the ability to the U.S. to use the dollar as a sanctions weapon.